One way to look at it is that emerging markets had a wonderful ride during the decade of the 2000s. There were three things that were going on that pushed their growth rates up very rapidly. First of all, liquidity, credit was growing quite strongly, and so a lot of that flowed into the emerging world. They complained about it a little bit in terms of strong currencies, but they actually enjoyed it. It meant they had a lot of credit at fairly cheap rates, and they used that for a variety of purposes, financing infrastructure and so on. So that was one very important trend. A second has been called the commodity supercycle, which is to say in the decade of the 2000s, you had this very sharp run-up in commodity prices. And even though it's been volatile since then, they've stayed at fairly high levels, although leveled off. So from that perspective, that strong commodity boom helped a lot of the commodity exporting emerging markets. And then the third big trend in the 2000s is what was called hyper-globalization. This was all that global sourcing that people talked about, a lot of companies sourcing overseas in terms of various parts in their supply chain, basically. And so all of these helped tremendously the growth in emerging markets. Now, each of those three forces has slowed down. It hasn't reversed, but it's slowed down. The sort of hyper-globalization has kind of leveled off a little bit. Commodity prices have leveled off. Credit growth isn't going to be or hasn't been quite as strong. So what's happened then is that those very strong tailwinds that were pushing these economies along just aren't there anymore. So that's a key reason why they've slowed down. Now, during those boom years, what they didn't do was they didn't put in place a lot of the structural reforms they needed to do, improve the structure of their economies, get rid of some inefficient state-owned enterprises, remove subsidies, which are just completely messing up their economies. So what they're stuck with is as the tide has sort of fallen in the global economy, now they're sitting on some rocks, basically, is the way to look at what's going on. China's not, of course, not a commodity exporting country. It has enjoyed the manufacturing boom. It especially enjoyed that hyper-globalization that we saw. And also, partly because of its own policies, it had a huge increase in credit. And you can see that in terms of the level of debt, for example, in the Chinese economy. Now, Chinese leaders know that they can't go on like this. So there's been some attempt to pull back a little bit in China. There's been some attempt to build up their domestic economy so they're not so reliant on exports, which of course was all that globalization was all about. And so China is trying to reorient itself, basically. Less dependence on exports, more on consumer spending. That process takes time. And in the recent big party plenum that they had, the third party plenum, they clearly want to go down that road, but it's not going to be easy. They'll probably do it because China has a way of doing what it says it's going to do, but it's not always easy, and it may take longer than I think the leadership would like it to take. I think the big risk is, in fact, they won't move fast enough down this road, that the entrenched interests, business interests that are so focused on exports, for example, don't want to give up that kind of power. The other issue, of course, is that China's population is aging rapidly, and so they have to deal with that at the same time. And so I think those are the key risks in terms of China. Last but not least, the credit bubble has fueled a housing boom. And they've got to figure how to scale that back without hurting the economy. So that's probably in the near term the single biggest hurdle facing the Chinese economy. Partly because of China's aging population, growth is actually going to come down. So in the near term, 7.5%, 8%, I think is certainly doable. Further out, say 10 years from now, I think they'll be lucky to be growing 6%. A lot of that is simply because the people aren't going to be there. I mean, just so they'll be facing a labor force reduction. Actually, we're likely to see Chinese labor force start to fall, the level fall, sometime in the next 5 to 10 years, and that, of course, will be a drag on growth, as it has been, for example, in Japan. One of the problems in Japan is a shrinking labor force. So China's got a challenge ahead of it, but I think they understand that. And I don't think it's in anybody's agenda to be growing 10% as they were, say, 10 years ago. I think if they can grow 6%, 10 years from now, then I think they'll consider themselves fortunate, which is by 6% by most country standards is an awfully good growth rate. For China, it's not so great, at least in comparison with what they've just been through. But I think all the demographics and other factors suggest that they probably won't be able to do much better than about 6%. India's challenges are very different than China's. On the one hand, it has some potential strengths in the sense that it took the road of really going down the route of exporting services rather than manufacturing. This was the whole back office shops in places like Bangalore and Hyderabad and so forth. So it wasn't so manufacturing focused, it was more services focused. So presumably that's a little less cyclical. But India as well had a bit of a credit bubble, a debt bubble, especially in terms of its corporations. And so, from that perspective, they've got to deal with that. India has a serious deficit and debt problem, which China does not have. It has an inflation problem that China does not have. So the policy response has to be different. They have to be tightening at a time when, let's say, China does not need to be tightening. But the biggest disappointment in India recently has been that they understand, at least some of the politicians understand, that they have to reform the economy. They have to open up the economy to competition. For example, to let in companies like Walmart that can make their retail much more efficient, for example. Whatever you think of Walmart, the point is that they're a very efficient retailer, whereas Indian retailers are very inefficient. But there's blocks and roadblocks everywhere to these kinds of moves of opening up the Indian economy to competition. And there's been a lot of investor disappointment in India's unwillingness, basically, in the end, to open up its economy to competition. So I think that's getting in the way of India. I think our view is a fairly optimistic one, and some may challenge us on that India will get its act together and the politicians will do understand that for them to grow rapidly, they need to do a lot of the things we've been talking about in terms of structural reforms. So I think our view is that will happen, but India has something going for it that China does not. Its population is going to keep growing. Its population is fairly young. It's not aging in the same way that China's is. And China's is aging because of the one-child policy. India doesn't have that. So in that sense, at least China's got what's often referred to as the demographic dividend working for it. So it's very different circumstances in terms of sort of medium to long-term growth. Brazil's an interesting country. It grew very rapidly until recently. But Brazil as well, I think, benefited from the trends of globalization, credit growth, commodities supercycle. Brazil exports a lot of commodities, of course. And there again, they enjoyed the ride. They got complacent. And they didn't do anything much. Now, what do they need to do? The issue in the case of Brazil is huge inefficiencies and very high costs. There's a phrase that people use about Brazil, the Brazil cost. Some of it is sort of high wages relative to productivity, let's say. Some of it's high taxation. Brazil has a very dysfunctional political, fiscal system and very high taxes. Their sales taxes are huge. So, for example, some people will end up paying twice as much in Brazil for an iPad, for example, than they would in the U.S. And recently there have been riots in Brazil to protest against that. The fact that they know what people pay in New York. Why should they have to pay that in Brasilia, Sao Paulo, Rio? Brazil is a very rich country, huge resources, natural resources. They've had bursts of growth, but they can't seem to sustain it. I think, as with so many of the other emerging economies, they've got to allow more competition. They've got to become much more efficient. They've got to get their costs down. The bureaucracy is just onerous. People talk about, at least half the government workforce essentially doesn't work. Now, you could say that of a lot of countries, but that is this sort of view of Brazil that that it's just full employment for a lot of people. A very large share of the population work for the government, but they're not doing nothing, effectively doing nothing. And a country can't develop under those circumstances. Russia's very a commodity-focused economy, and clearly the movements in the prices of commodities drive the economy up or down, as the case may be. The problem is twofold. One is that they have not been very encouraging to foreign investors coming in, and they need that capital. They're very xenophobic, if you want to say it. They're very nationalistic. They're very suspicious of Western companies, especially American companies. And so the unwillingness, again, to allow foreigners to come in to develop their natural resources is a key hindrance. The other is that this particular government, the government of Mr. Vladimir Putin, has essentially used a lot of the money that's come in on oil for their own wealth. I mean, there's a lot of corruption in Russia. And so it hasn't been used to develop the economy, to diversify the economy, to make it sort of grow on a more sustainable basis, not as dependent on the fluctuations in commodity prices. So from that perspective, Russia, too, needs to do a lot more in terms, primarily in the case of Russia, diversifying its economy and being less autocratic. I mean, it's a less dependence on the government and government-run and government sort of sponsored companies. One of the things that Russia's trying to do is, right now, is become part of the World Trade Organization. In fact, it's been allowed to become part of the World Trade Organization. Normally, governments will agree to do a lot of, in the way of reforms, reduce tariff barriers and so on and so forth, whereas the Russians have asked for a lot of exceptions. So yes, they've joined the World Trade Organization, but unlike, say, China, which joined a little over 10 years ago, Russia has not done anything, or at least not agreed to do a lot of the stuff that countries normally do when they join the World Trade Organization, which is to say they free up their trade and they open up their economies. And Russia really hasn't done that. It's resisted doing that.